Hey there, everyone. I'm Kelly Longtin from Kelly Longtin Law, and today I want to talk to you about types of life insurance and how they can be used in estate planning. So for many of us, we didn't start thinking about life insurance until we got our first full-time job, and the company's human resource representative asked us if we wanted to enroll in the employer's group life insurance policy. So most of us think, why not? And we sign up naming a family member as the beneficiary of their policy, and then never give it another thought. Although this may be a good start, too few of us spend much more time thinking about these life insurance policies and how they affect our estate plans. So what is life insurance? In general terms, life insurance is a contract between two parties, usually an individual and an insurance company, in which the company agrees to pay a specified sum of money, which is the death benefit, upon the death of the insured to the beneficiaries that have been named in the policy to replace the economic loss that would otherwise be incurred by the beneficiaries because of the insured's death. In exchange for the death benefit, the individual who purchased the policy agrees to pay premiums to the company for a specified period of time, up to a specified amount, or both. Now, the right kind of life insurance, when properly understood and carefully coordinated with your estate planning, can provide significant economic benefits and peace of mind for you and your loved ones should you pass away sooner than expected. But there are numerous types of life insurance, and it can be well worth your time to become familiar with the primary varieties and know when to use them. And my goal is to be able to help you with that, to at least open your eyes so you know the different types of life insurance policies that are out there and how they work. So there's lots of different types. There's term life insurance, whole life, universal life, variable life insurance, variable universal life insurance, survivorship life insurance, first to die life insurance, and single premium life insurance, just to name a few. So let's start at the beginning and go over what term insurance is. Term insurance will pay the death benefit only if the insured dies within that specified period of time spelled out in the insurance contract. So for example, if the policy is for a 10-year term, but the insured dies in year 11, after the 10-year term has ended, no death benefit is payable to the beneficiaries. Now, this type of insurance is generally more affordable than other types of policies and is designed primarily to protect the insured beneficiaries should premature death create economic hardship within that specified term period. And next we have whole life insurance. Whole life insurance typically guarantees a consistent premium throughout the life of the contract, but the premiums are typically higher than term life premiums because the insurance company maintains a reserve that helps keep the premiums level during the insured's life. The reserve is an accumulated cash value within the policy that the policy owner can borrow against or cash out if they choose to terminate the contract before they die. Now, different varieties of whole life insurance have unique features that can be customized for particular situations. So you'd want to speak to your life insurance salesperson or agent for that. So let's talk about what universal life insurance is. Universal life insurance policies are interest-sensitive policies that can result in higher death benefits and cash value over the life of the policy, depending on a variety of investment, expense, and mortality factors that are built into the contract. With the potential for greater gains in cash value, however, comes the potential for greater risk in the buildup of cash value. If the policy's underlying investment assets perform poorly and the cash value buildup is insufficient to cover the expense charges and mortality costs, the policy will terminate. However, compared to whole life policies, universal life policies are generally significantly more flexible with regard to making premium payments from year to year and withdrawing cash value. Therefore, depending on your circumstances, the type of cash flow that you anticipate, and the risk that you're insuring against, a universal life policy may be appropriate for you. As with most insurance policies, you'll find limitless varieties from insurer to insurer. So let's talk about variable life insurance. Variable life insurance policies are very similar to traditional whole life policies, except that in variable life policies, neither the death benefit nor the surrender value of the policy is guaranteed. In addition, either the death benefit or the surrender value, or both, could increase or decrease depending on the performance of the policy's underlying investments. However, each variable life policy typically has a minimum death benefit, so that even with poor asset performance, the beneficiaries receive a payout at the insured's death. Now, these policies are unique because of the control that the policy owner has over the types of investments underlying the policy. The policy's cash value can be invested in varying degrees in stocks, bonds, real estate, and money market portfolios. Now, policy premiums are typically fixed, but depending on the underlying asset performance, the cash value can fluctuate from day to day. As with other life insurance products, the death benefits are income tax exempt. The earnings on the assets and the accumulated cash value in the policy are income tax deferred until after the policy has been surrendered. In addition, the policyholder can also borrow up to a certain percentage of the policy's cash value if they need cash for a period of time, although that interest is charged while the loan is outstanding. Now, variable life insurance, or variable universal life insurance, is, as the name indicates, a hybrid of variable life and universal life insurance, with many of the most desirable features of both types of insurance built into these contracts. There's flexible premiums, adjustable death benefits, control over the types of assets within the policy, the ability to grow against the cash value, partial and partial withdrawal rights. Both variable universal life and variable life policies are subject to Securities and Exchange, the SEC, regulations because of the flexibility of their investment options. Now, survivorship life insurance. This is sometimes called second to die, so you probably have heard of that. So second to die life insurance. Survivorship policies can be used when the need for an infusion of cash, the death benefit, is necessary only at the death of the second of the two individuals, such as a married couple. Now, these policies can be term or whole or universal or variable, depending on the policyholder's need. Survivorship policies are particularly useful when a married couple owns significant real property that they want to keep in the family after the second spouse dies, and the family would rather pay estate taxes from the life insurance proceeds than raise the cash to pay the taxes by selling the property. Then there's first to die life insurance. First to die policies allow the death benefit to be paid upon the death of the first of the two insured individuals. Insuring two individuals instead of one costs less than the total premium for separate life insurance policies on the same two individuals. For example, these policies can provide a surviving business partner with the cash necessary to buy the deceased partner's share of the business from their spouse or family. Single premium whole life insurance. Let's talk about that. Single premium whole life insurance allows an individual to purchase with a single cash payment a specified amount of insurance to cover the remainder of their life. As with typical whole life, the insured can borrow against the policy's cash value or surrender the policy. There may be income tax consequences for surrendering the policy, but as with most other life insurance policies, there can be significant income tax protection if the policy matures and pays out at the insured's death. Also, in some states, the cash value of life insurance can enjoy significant asset protection against the future creditor's claims, thus making investing in life insurance more attractive than other types of investments. So how do you know which type of insurance is best for you? With all of the choices available in the life insurance world, considering what type of insurance is best for your situation can feel overwhelming. Now, if you're a young couple just starting out and you don't have much spare income, it may be best to shop for some term insurance that will provide a cash payment that allows your surviving spouse to pay off the home and have sufficient income until they can provide for themselves on their own. Now, if you're a middle-aged working professional with a family, you may want to consider purchasing a much larger term life policy or even a whole life policy that has a guaranteed death benefit as long as you keep paying those premiums. This option can be important if there's a chance that you could develop a chronic illness, such as diabetes or cancer, that would disqualify you from obtaining a new term policy when your old term policy terminates. Now, if you have a large estate with significant assets that would be difficult to sell, such as a successful business or real estate, a second to die or first to die policy might be a better option for ensuring that there's sufficient cash upon the death of one or both of you and your spouse or business partners to pay taxes or to buy out a deceased partner's business interest. The bottom line is that life insurance policies come with a huge variety of options because families and individuals have an endless variety of circumstances. So ask your insurance professional, a financial advisor, and estate planning attorney to help you identify the risks that you may be facing that could be reduced by using a carefully crafted insurance policy. You want to coordinate with your estate planning as well to meet your unique needs for your family. Now, insurance can be complex, but you don't have to go it alone. So you want to make sure that you reach out to an agent who sells life insurance and who is very well experienced in that, and have a conversation with both them and your estate planning attorney. So I want to thank you for watching. I hope this was helpful. I'm Kelly Longtin from Kelly Longtin Law.